Welcome back. Position sizing explains 90% of your trading performance. 90%. Yet most traders spend 90% of their time hunting perfect entries and chart patterns. They're optimizing the wrong thing. In our last video, we covered the institutional grade framework for risk management, the 1% rule. That answered the first critical question: how much can I lose? Today, we answer the second question: how much should I bet? This is position sizing, the difference between steady growth and catastrophic drawdowns. Think in odds, act with discipline. Let's begin. Van Tharp studied professional traders for decades. His analysis across thousands of traders, published in Position Sizing, the Key to Trading Success, found that position sizing accounts for 90% of performance variation. Not entry accuracy, not win rates, not chart patterns. Position sizing. Here's what that actually means. Take two traders. Same strategy, same entries, same exits. Trader A risks 1% per trade. Trader B risks 5% per trade. Same 60% win rate with 2-to-1 reward risk. Over 100 trades, Trader A's account compounds steadily upward. Trader B faces catastrophic drawdowns that become mathematically impossible to recover from. Seriously. Same edge, opposite outcomes. That's the power of position sizing. The Uppsala University study proved this experimentally. 52 participants traded simulated stocks. Bankrupt traders risked 22.9% per trade on average. Survivors risked 6.6%. 3.5 times more risk led to total destruction. But here's what's fascinating. They gave one group a 3-hour lecture on position sizing. Bankruptcy rate dropped from 40% to 6.3%. More than a 6 times improvement from just 3 hours of education. Now don't worry if some of the math coming up sounds complex at first. Once you see how it applies to real trades, Apple, Amazon, Nvidia, you'll get it. I'm going to break it down so it makes sense. Let's start with the foundation. There are 3 frameworks every trader needs to understand: Kelly Criterion, fractional Kelly, and risk-based position sizing. Let's start with Kelly, but I'll keep it simple. Back in 1956, John Kelly at Bell Labs discovered something profound while working on information theory. The formula for maximizing long-term growth is mathematically identical to maximizing information transmission through a noisy channel. It's not an analogy. It's the same equation. Here's what matters. Kelly says position size equals your edge divided by the odds. For stocks, position size increases with your edge, but decreases quadratically with volatility. Translation? If volatility doubles, you cut position size by 75%, not 50%. Volatility kills you way faster than most traders realize. Let me show you with Microsoft. Your backtest shows 15% expected annual return. Risk-free rate is 5%. Microsoft's volatility is 25%. Full Kelly says 15% minus 5% divided by 25% squared. That's 160% of your capital. Full Kelly wants you leveraged 1.6 times. Can you handle a 50% drawdown? Because that's what Full Kelly produces. That's why every professional uses fractional Kelly. Warren Buffett uses about quarter Kelly. George Soros uses half Kelly. Take that 160% and multiply by 0.25. That's 40% of capital in Microsoft. Still aggressive, but survivable. But here's the truth. Most traders don't need Kelly at all. They need something simpler. Risk-based position sizing. Here's how it works. Pick your risk per trade, 1% to 2% for most traders. Divide by your stop distance in dollars. That's it. Example, you've got a $50,000 account. You're buying NVIDIA at $140 with a stop at $135. That's $5 risk per share. 1% of $50,000 is $500. Divide $500 by $5 per share, 100 shares maximum. No complex formulas, no probability estimates, just account size times risk percentage divided by stop distance. Now there's one more concept we'll dig deeper into later. Portfolio heat. That's the total risk across all your positions at once. Portfolio heat defines your true risk, not individual position size. We'll come back to this, but keep it in mind.
Now here's where 99% of traders fail. Not in the math, in the mind. Kahneman and Tversky prove that losses hurt twice as much as gains feel good. The 2-to-1 pain ratio isn't psychological theory, it's measurable neural response. The brain literally processes losses differently. Here's what happens in practice. A trader loses $1,000 on Meta. Account drops to $49,000. The brain starts making deals. If I just double my next position, I can get back to even. That's the death spiral. Traders go from risking $500 to risking $2,000. When that loses, now they're down $3,000 and thinking about $4,000 positions. Let me show you how this plays out even when traders know the odds. The Hagani-Dewey experiment crystallized this perfectly. They gave 61 financially educated people a simple game. Flip a coin that lands heads 60% of the time. Even money bets. Starting bankroll, $25. 30 minutes to play. They did the Kelly math. They knew optimal bet size was 20% per flip. They had calculators. They knew the exact probabilities. Imagine you're in that experiment. You know the coin lands heads 60% of the time. You calculated 20% per flip is optimal. But after 2 losses in a row, you're thinking, just one big bet to get back to even. That psychological pressure, it's identical to live trading. Traders feel invincible after wins. They feel desperate after losses. The math doesn't change. Behavior does. Results? 28% went broke. Average payout was only $91. Just 21% hit the $250 maximum. These people knew the exact odds. They had calculators. 30 minutes to figure it out. They still failed. Now think about real trading. Traders don't know the probabilities. Netflix can gap down 35% after earnings. A trader's 70% win rate might actually be 55% after bias correction. Overconfidence is everywhere. Terry O'Dean studied 10,000 brokerage accounts over 7 years. The most active traders had the worst results. Men traded significantly more than women, in some studies around 45% more, and achieved significantly worse returns. Overconfidence leads to overtrading. Overtrading leads to oversizing. Oversizing leads to ruin. The drawdown math is unforgiving. Think about this carefully. A 10% loss needs an 11% gain. Minor difference. A 30% loss needs a 43% gain. You can see the inequality growing. A 50% loss needs a 100% gain. The account has to double. 70% loss needs 233% gain. 90% loss needs 900% gain. 900%. This is why position sizing isn't about maximizing returns. It's about maximizing survival. All right, here's the actual system you use. This integrates everything into one framework. Layer 1, base calculation. Account size times 1% to 2% divided by stop distance in dollars. Trading Amazon at $195, stop at $188. That's $7 risk per share. $50,000 account at 1.5% risk, $750 divided by $7.
about 107 shares. Layer 2, volatility adjustment. Check your broker's ATR indicator, average true range. If Amazon's ATR over the past month is running 50% hotter than normal, reduce your position proportionally. Month's average ATR is $5. Today it's $7.50. That's 50% higher, a 1.5x multiplier. Divide your position by 1.5. Your 107 shares becomes 71 shares. If volatility doubles, 100% higher than normal, cut your position in half. Divide by 2. Simple rule. Higher volatility equals smaller position. Your broker shows you this data. Use it. Layer 3. Portfolio heat. Here's the full explanation. Add up the total dollar risk across every position you're currently holding. Say you're in 3 trades. Apple risking $500, Amazon risking $750, Tesla risking $600. That's $1,850 total risk on your $50,000 account. 3.7% portfolio heat. Most traders should cap this. 10% heat for conservative traders, 15% for moderate, 25% for aggressive. Once you hit your limit, no new trades, regardless of how perfect the setup looks. This prevents correlation-driven simultaneous losses from exceeding recovery capacity. It's not individual position size that kills accounts. It's cumulative exposure when everything moves against you at once. Layer 4. Drawdown adjustment. If your account is down more than 10% from peak, cut all position sizes by 25%. Down 20%, cut by 50%. Down 30%, minimum size or stop trading entirely. This is Paul Tudor Jones's rule. When I'm trading poorly, I reduce my position size. That way I'm trading my smallest positions when my trading is worst. It's anti-martingale. Traders reduce after losses, increase after wins. This prevents the double down to recover trap that destroys accounts. Layer 5. The minimum rule. Here's how it all comes together. Ask yourself, which rule restricts me most? Kelly says 100 shares. Risk-based says 120 shares. Volatility says cut to 60. Portfolio heat says you're maxed out at 8%. No new positions allowed. Your actual position? 0 shares. You wait. The smallest number always wins. Every constraint has veto power. Survival beats optimization. All right, now here's the contrarian part. Everything I just taught you, professional rules, conservative sizing, discipline frameworks, but every once in a while, maybe once every 20 years, the rules change. September 1992. George Soros and Stanley Druckenmiller are shorting the British pound. Druckenmiller wants to put 100% of the fund into the trade. Soros looks at him with disdain. Go for the jugular. This comes around once every 20 years. You should be doing 200%. They leveraged to 200% of fund value, made $1 billion, 69% return for the year. Now, before you romanticize this, understand, this is a statistical anomaly born from stacked certainty, not confidence. This isn't permission to gamble. This is mathematical justification for concentration under extreme conditions. So what's actually happening here? They had 5 independent edges stacking up. Edge 1, economic fundamentals. Germany needed high rates for reunification inflation. Britain needed low rates for recession. The math didn't work. Edge 2, political intelligence. Direct access to Bundesbank officials. They knew what was coming before markets did. Edge 3, technical setup. The pound was at the top of its trading band. Defined risk with clear exit points. Edge 4, reflexive influence. Their position was large enough to exhaust Bank of England reserves. They could influence the outcome with their size. Edge 5, asymmetric payoff. Risked 12% maximum loss for 15% to 20% gain. But market dynamics meant practical risk was under 1%. That's why 200% made sense, not overconfidence.
exponentially better information quality across multiple independent dimensions. But here's the key. Soros didn't do this every year. Once in 20 years. Warren Buffett's 1966 partnership letter said he'd invest up to 40% in a single security, but only under conditions coupling extremely high probability our facts and reasoning are correct, with very low probability anything could drastically change underlying value. Then he added, we're obviously only going to 40% in very rare situations. Very rare. Most traders hear these stories and think, that could be my next trade. It's not. You'll see maybe 1 or 2 of these in your entire career if you're lucky. The rest of the time, 1% to 2% risk per trade, portfolio heat under 20%, discipline, survival, consistency. That's the real edge. Here's what you do starting tomorrow. Step 1. Calculate your base risk. Take your account size, multiply by 1%. That's your baseline per trade. $50,000 account, $500 base risk. Step 2. For the next 20 trades, use only baseline sizing. No conviction scaling. No, this one's different. Just baseline. Why? Traders need to calibrate. Most traders think their 80% conviction setups win 80% of the time. They actually win 55%. That's overconfidence bias. Step 3. Track everything. Before each trade, write down your conviction level, 1 to 10. After it closes, record the R multiple outcome. Risked $500, made $1,500, that's 3R. Lost $500, negative 1R. After 20 trades, plot conviction versus outcomes. Were your 8 conviction trades actually better than your 5 conviction trades? Or were they just lucky? If you're not sure, keep tracking to 50 trades before adjusting position sizing based on conviction. Calibration requires enough data to separate skill from variance. 20 trades isn't enough for certainty. Step 4. Portfolio heat tracking. Before any new position, add up current risk. Already at 8% across 3 trades? No new positions. I don't care if Apple looks perfect. Discipline beats discretion. Step 5. The Paul Tudor Jones rule. 3 losses in a row? Cut position size in half. Not maintain discipline and push through. Cut in half. Trade your smallest when trading worst. Scale up cautiously when trading well. Look, position sizing isn't sexy. It's not Instagram worthy. It won't make for dramatic stories. But Van Tharp proved it explains 90% of performance variation among professionals. Master this one skill, you're ahead of 90% of traders. Most trades, 1% to 2% risk. Portfolio heat under 20%. Boring. Disciplined. Effective. And once every 20 years, when 5 independent edges stack up, when payoff is asymmetric with defined risk, then you go big. But that's the exception, not the rule. Here's what people don't tell you about discipline. Discipline isn't restriction. It's freedom. Freedom from fear. Freedom from revenge trading. Freedom from the randomness that destroys accounts. That's what mastering position sizing really gives you. So let me recap what we've built so far. Video 1. How much can I lose? The 1% rule gave you survival. Video 2. Today. How much should I bet? Position sizing gives you growth. Video 3. Coming next. Is this bet worth taking?
Expectancy mathematics will tie it all together. That's when you'll know if your edge is real or imaginary. Calculate your baseline. Track your next 20 trades. Build your calibration curve. Master the 90% that actually matters. Think in odds. Act with discipline. See you in the next one.